In this video, I'm going to be basically talking to you about how every retail trader gets it wrong, how nobody knows exactly what to look for in the markets, how guys like Druckenmiller, George Soros, and basically every macro fund out there in New York City manage their books, exactly what indicators and what data they look at, and how they actually make decisions. In this video, we are exactly going to go through that. Now, why should you listen to me and how do I know all this stuff? I was mentored by the Institute of Trading and Portfolio Management ex Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital, based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio. Almost every fund in New York except Cathy Wood's ARK ETF, which if you follow right now, you're an absolute joke and you have no idea what you're doing. Every big fund which actually moves serious amount of money follows a very similar approach. They use a top-down, bottom-up style approach. They look at what the economy is doing, the major moves made by the Fed, the major quantitative easing, QT, QE rules. They look at major macro data, which includes ISM new orders, new CPI reports, PCE numbers, jobless claims, and non-farm payrolls numbers. All of that based on rate of change, which is basically based on a year of year number, which basically means that these numbers are compared to what these numbers were printed last year. So I will be providing you guys a list of all the major economic numbers, all the major numbers you can basically look at to dispassionately judge which regime we are in right now, which sectors outperform in which regime, and which sectors underperform in which regime. This is basically what professional players in hedge funds and professional traders really look at. So I'll give you guys an example. So in an environment where we have growth slowing and inflation slowing, which is basically a deflationary environment, what really happens in that environment is that equities and growth really slows down. And in this situation, you'd really want to be long municipal bonds. You'd want to be long the TLT. In this type of environment where we have lower real yields, which is basically just the 10-year yield subtracted by the inflation rate. In a lower real yield environment, we have gold and other commodities outperforming bonds in itself. So we have bond yields falling. We are basically long the TLT, the BBN, municipal bonds, and long term treasury bond prices. We are also long gold when this is happening. So we're long all these assets. And we're basically short growth and don't really have a lot of expectation out of growth, tech stocks, and discretionary at this time. This is when we have a deflationary environment, and this can come when we have a lower CPI number, lower GDP growth, expectations, slower ISM number, slower ISM new orders, which is basically exactly the blueprint which most fund managers in New York follow. These are the exact numbers they look at. They look at the yield curve, which is basically the 10-year bond yield subtracted by the 2-year bond yield. The yield curve can either steepen or it can flatten. Now, what happens is that if you have a steepening yield curve, that's actually really good for banks because banks can actually borrow money with a short term loan, which is basically in the 2-year, and sell that at a higher loan, at a higher rate, a higher yield to the customer. So usually what happens is that when you have a steepening yield curve, that's actually really beneficial for banks. And when we have a flattening yield curve, which is it's horrible for banks because they aren't able to do a lot of business. Now, if we look at a JP Morgan example, from 28th Feb to about July, when the Fed started hiking and initiated its quantitative tightening program back on about end of Feb 2022, what happened is that JP Morgan corrected about 33% and the S&P corrected much less than that. So in a yield curve flattening environment, we usually have financial stocks seriously underperforming major stocks, the broader indices. So, just by using situations like that, you guys can really understand that, depending on the macroeconomic regime, depending on whether we're getting a yield curve steepener or a yield curve flattener, what high yield option adjusted spread, credit spreads, HYG, JNK, LKD, investment grade bond credit, the bond credit market, whether we have these yields going up or going down. These are exactly the indicators which professional traders use to dispassionately judge which regime we are in right now, where the market is actually going. And based on these indicators, what they signal, the market is able to correctly price, not even the market, professional traders are correctly able to judge what's going to happen next. Now, I'll give you another example. Back in about 2019, when we had a yield curve inversion, which basically just means that the 10-year bond yield was lesser than the 2-year bond yield. What happened then was that the New York Fed put a paper out in which they basically said that even though we have a yield curve inversion, and by the way, this indicator, yield curve inversion, has successfully predicted every recession since 1955. Every goddamn recession since 1955, a yield curve inversion. Following a yield curve inversion, 6 months after that, we have had a recession 6 months right after that. Now, back in 2019, when the yield curve had inverted, the New York Fed came out with a paper basically talking about how this time is different, and this time we aren't going to get a recession which follows through. Now, it did come in the form of COVID, where the market corrected heavily. Well, that is a forward-looking indicator, and a yield curve inversion usually predicts underconfidence in long-term market outlook. And usually within 6 to 12 months, we've always had a correction right after a yield curve inversion, and it disinverts after the Fed starts cutting rates like crazy. So, guys, this is all basic macroeconomic stuff. You won't learn this in a Yale economics course or a Harvard economics course. They won't teach you practical stuff like this. Well, Stan Druckenmiller said it himself after doing a PhD in economics from University of Michigan that practical economics and the modern portfolio theory and how markets price everything efficiently is total garbage. So many fund managers make a lot of money through pricing inefficiencies in the options market right now. It's a total joke. So, guys, you gotta judge the situation dispassionately. You need to get the correct information. Yes, this is like a highly technical and highly complicated video, but in all seriousness, this is exactly the every single goddamn indicator I've listed right now is exactly what Wall Street monitors like a hawk. And this is exactly what they look at before actually placing trades and deciding which regime they are in right now. So you really want to watch this video again. I actually encourage you to watch this video again because it is super complicated. I've just gone over a lot of things extremely fast. You want to watch this video again and you want to save it. And every single indicator I've listed, you want to see what the broad market has done. For example, when we have the high yield option adjusted spread going up vertical like crazy, see how the market responded to that. See what happened after every yield curve inversion we've had since 1955, 1997, 1999, 2007, 2019, and 2024. These are all the times when the curve has been inverted and proceeding, or like right after that, we've had a major drawdown in the market, in the broad market indices. You want to check these indicators, guys. Watch this video again, please.